Are you curious about the stock market but not sure where to start? Or maybe you've heard it's too risky and want to know how to invest safely. Today, we're going to break down the basics of investing in the stock market. We'll cover what the stock market is, how it works, and simple strategies to get started. First, let's understand what the stock market really is. Think of it as a marketplace where companies sell shares to raise money. When you buy a share, you're buying a small piece of that company. This means you become a part owner of the business. If the company grows and profits, the value of your share goes up. And if the company struggles, the value of your share can go down. It's that simple. But there's more to it. There are two main ways to earn money with stocks. The first is through capital appreciation. This happens when the value of your shares increases over time. The second way is through dividends. Dividends are payments made by a company to its shareholders, usually from profits. Not all companies pay dividends, but those that do provide regular income on top of any increase in stock price. Now, let's talk about the two main types of stocks, common and preferred. Common stocks give you voting rights and potential for high returns, but they come with more risk. Preferred stocks typically don't have voting rights, but they offer fixed dividends and are generally less risky. Next, you need to know about stock exchanges. This is where buying and selling of stocks take place. The most well-known exchanges are the New York Stock Exchange, NYSE, and the NASDAQ. Companies listed on these exchanges have to meet strict financial standards, which helps protect investors. Now, how do you choose which stocks to buy? Start by researching companies you're interested in. Look at their products, financial health, and how they're performing in the market. Read earnings reports, which show how much profit a company is making. Check the company's debt levels. A company with high debt might struggle to pay it off, which can be risky for investors. Also, consider the company's position in its industry. Is it a market leader or a smaller player? Market leaders usually have more resources and stability. But sometimes, smaller companies can offer more growth potential. When choosing stocks, it's important to diversify. Diversification means spreading your investments across different sectors and industries. For example, don't put all your money into tech stocks. Instead, invest in a mix of sectors like technology, healthcare, and consumer goods. This way, if one industry suffers, your entire portfolio isn't affected. A good starting point for beginners is index funds or ETFs. These are collections of stocks that track a specific index like the S&P 500. By investing in an index fund, you're buying a small piece of many companies at once. This spreads out your risk and makes it easier to get started. Now, let's talk about the importance of time in the market. The stock market can be volatile in the short term, but it generally trends upward over the long term. That's why it's important to think of investing as a long-term strategy. If you buy a stock, plan to hold it for at least 5 to 10 years. Don't get scared by short-term fluctuations. If the market drops, it's not necessarily a bad thing. Think of it as stocks going on sale. If you're investing for the long term, these dips can be opportunities to buy quality stocks at a lower price. Another key principle is dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of the stock's price. For example, you might invest $100 every month. This approach helps you avoid the mistake of trying to time the market. When prices are high, you buy fewer shares, and when prices are low, you buy more. Over time, this strategy can lower your average cost per share. But remember, not all stocks are good investments. It's crucial to avoid speculative stocks. These are stocks that have high potential but also high risk, like penny stocks. They might promise big returns, but they're often very volatile and can lose value quickly. Instead, look for companies with a strong track record of growth and profitability. And don't forget about fees. When you buy and sell stocks, you might have to pay fees to your broker. These fees can add up and eat into your profits. Look for low-cost brokerage accounts and avoid frequent trading to keep costs down. Now, let's bust a common myth. You don't need a lot of money to start investing. Many brokerage platforms allow you to buy fractional shares. This means you can buy a portion of a share instead of the whole thing. So, even if a stock costs $1,000, you can invest with as little as $5. It's more important to start small and be consistent than to wait until you have a lot of money. And here's another myth. Investing is like gambling. This isn't true if you have a strategy and stick to it. Gambling is based on luck and has a high risk of losing everything. Investing, on the other hand, is based on research and long-term planning. You make calculated decisions to grow your money over time. It's also essential to avoid emotional investing. Don't buy a stock just because everyone else is. And don't sell in a panic because the market drops. Emotional decisions often lead to poor outcomes. Instead, focus on your long-term goals and stick to your investment plan. If you're new to investing, start with small amounts. This way, you can learn without risking a lot of money. As you gain experience and confidence, you can gradually increase your investments. Always remember that investing involves risk. You can lose money, especially in the short term. But with knowledge and a solid strategy, you can manage those risks and grow your wealth over time. And before you start investing, make sure you have a solid financial foundation. This means paying off high-interest debt and having an emergency fund. Investing should be part of your overall financial plan, not a standalone strategy. And most importantly, this video is for educational purposes only and does not constitute financial advice. Always consult with a licensed financial advisor before making any investment decisions. They can help tailor an investment strategy that fits your unique financial situation. Investing in the stock market is a powerful way to build wealth over time. But it requires patience, discipline, and a willingness to learn. Start small, stay informed, and stick to your plan. The earlier you start, the more time your money has to grow. So take that first step today. Need to keep your screen looking busy? Sign up for our free email newsletter. Don't forget to like, subscribe, and get notifications for more Money Mindset Makeover content.